and welcome to Rockstar Manager. I'm Dr. K, the management professor, and this episode is all about accounting terminology and financial statements. First, please subscribe to my channel by hitting the subscribe button down below, and also hit the notifications button so you'll see each time I post a new video. If you want to celebrate excellent work in your office, if someone is a rockstar manager, a rockstar analyst, researcher, musician, chef, rockstar anything, check out rockstar-manager.com for various gifts and swag items. Now let's get started. For whatever reason, many people aren't comfortable with numbers, and especially accounting. In this video, I walk you through accounting from more of a layman's perspective, more of a storytelling, than from an accounting perspective or an accountant's perspective. So let's define accounting. Accounting is the process of measuring, interpreting, and communicating financial information so that people inside and outside the organization can make informed decisions. For example, business owners, stockholders, investors, and creditors use accounting to evaluate operations of the organization and to make investment decisions. Management uses accounting to plan and control. Employees and union officials use it in contract negotiations. Lenders and suppliers use accounting to evaluate credit ratings. Government agencies use it to evaluate tax liabilities. And economic planners and consumer groups use accounting to approve new issues of stocks and bonds. Ultimately, people both inside and outside the organization rely on accounting information to help them make business decisions. Open book management is the sharing of sensitive financial information with employees and teaching them how to understand and use financial statements. The information that they have might help them better understand how their individual work contributes to the overall success of the company. Additionally, outsiders use financial data to evaluate investment opportunities. Specifically, there are 3 business activities that involve accounting: financing, investing, and operating. The natural progression of business will actually begin with financing and investing, then leads to operating. Specifically, financing activities provide necessary funds to start a business and expand it after it begins operating. Then investing activities provide valuable assets required to run a business. Operating activities focus on selling goods and services, but they also consider expenses as important elements of sound financial management. There are 4 types of accounting professionals: CPAs, CMAs, government, and not-for-profit accountants. Public accountants provide services for individuals or firms for a fee. Often known as certified public accountants or CPAs, they demonstrate their accounting knowledge by meeting state requirements. Second are CMAs. Some management accountants achieve a Certified Management Accountant, CMA, designation through experience and passing a comprehensive exam. Management accountants are focused on information for decision-making. Government and not-for-profit accountants work somewhat the same as management accountants, and they're focused on efficiency of the organization. Then there are a variety of regulatory bodies in the accounting world, such as GAAP, FASB, and SOX. GAAP is Generally Accepted Accounting Principles, GAAP, and they encompass conventions, rules, and procedures for determining acceptable accounting practices at a particular time. The Financial Accounting Standards Board, FASB, FASB, is primarily responsible for evaluating, setting, or modifying GAAP in the United States, and the Sarbanes-Oxley Act, SOX, or otherwise known as SOX, responds to cases of accounting fraud. The Public Accounting Oversight Board sets audit standards and investigates and sanctions accounting firms that certify the books of publicly traded companies. Additionally, senior executives must personally certify that the financial information reported by the company is correct. And over the years, we've seen an increase in ethical demands for accountants. So let's talk about the accounting cycle. The accounting cycle is a set of activities involved in converting information about transactions into actual financial statements. To say it another way, the accounting process deals with financial transactions between an organization and its employees, customers, suppliers, and owners, as well as bankers and various government agencies. The procedure by which accountants convert data about individual transactions to financial statements is called the accounting cycle. Basic data is processed. Basic data includes receipts, invoices, and other records that justify making an entry into the organization's accounting system. That basic data is then processed. Processing involves recording, classifying, and summarizing. Recording is basically creating an electronic journal entry for the identified dates and explanations for each of those entries. Then it's classified into different categories. These journal entries are posted to a ledger, often in a cash or sales account. From there, it's summarized, and at the end of the accounting period, financial statements are prepared from these summaries. So now let's talk about the basic accounting equation, which is assets equals liability plus owner's equity. An asset is anything of value that is owned or leased by a business. A liability is a claim against a firm's assets by a creditor. Owner's equity includes all claims of the proprietor, partners, or stockholders against the assets of the firm, and they're equal to the excess of assets over liabilities. The accounting equation illustrates double entry bookkeeping, which is the process by which accounting transactions are entered individual, and there are each individual transactions on either side of the T account. So there's essentially offsetting transactions. A budget is a planning and control tool reflecting expected sales revenue, operating expenses, cash receipts, and outlays. Management estimates the flow of money. Budgets are a blueprint that serve as a financial plan, and the cash budget tracks the firm's cash inflows and outflows. So everything that comes into the organization and everything that goes out of the organization. So when you're creating a budget, you want to look at what happened in the past, represented by your statement of cash flows, your balance sheet, which is the present day, it's a snapshot, and your budget, so you can see how you can forecast in the future. First, you make and reconcile budget estimates and plan cash flows. Second, you track spending, and then you budget for large purchases, and then you record the purpose of those expenditures. You monitor the credit transactions and any overspending, and then you evaluate the variance. So if you planned for this, was it short or over whatever that anticipated number was? Hopefully you have some carryover money, so you want to plan in advance how you can budget that. Now let's briefly go over some financial statements. Financial statements provide managers with information for evaluating the organization's ability to meet the current obligation and needs, essentially what it owes, its profitability, and its overall financial health. The balance sheet is the first of these statements. The balance sheet is a statement of a firm's financials on a particular day. It's a snapshot of a firm's assets, liabilities, and owner's equity at a given point in time. So assets are what is owned, and they include 1, monetary assets, which can be liquid assets or cash equivalents, such as bank accounts. 2, they can be tangible or use assets such as a car or a house. And or 3, investments or capital assets, such as a 401k. Liabilities are what is owed. They include short-term, which is like a credit card bill, and long-term, which is like a mortgage. So when you subtract your liabilities from your assets, you get your net worth. So whereas the balance sheet is a snapshot, the income statement is more like a video. Income statements maintain the information to calculate financial ratios. An income statement is a financial record of a company's revenue, expenses, and profits over a period of time. It's also known as a P&L, profit and loss statement, and it reports as such, profits or losses. Here, the focus is on revenues and expenses. Income is called revenue, so money coming in to the organization, and expenses are paid out of the organization, money leaving the organization. And the net profit or loss is what's left. So it's going to be a profit if the money is left over after all the expenses are paid, and it's a loss if there are more expenses than income. So hopefully you have a better understanding of accounting terminology and how it flows. If you're interested in learning more about related managerial topics, you can read Boone and Kurtz's Contemporary Business, or you can find my books, Rockstar Manager from Theory to Practice, Mindset, a research-based approach to understanding motivation, or my latest book, Be Your Best You, the ultimate research-based guide to outstanding leadership. They can be purchased on Amazon and at most major retailers. Thank you for your time. Be your best you and be a rockstar manager.